The U.S. government is over $34 trillion in debt. And now the interest payments are higher than our military spending. So let me ask you, what happens to real estate when the dollar dies? We've seen this movie before. When the government prints like crazy and the confidence cracks, many times sending the currencies into collapse. But chaos, that's where the biggest opportunities are made. And today, I'll show you what it means for the real estate industry. Let's start with the fundamentals. The U.S. debt to GDP is exploding. It's unsustainable. And here's the issue. The Treasury cannot raise interest rates without tanking the economy. But if they don't, inflation gets out of control. Either way, the Fed is boxed in. And foreign buyers like China and Japan, they're pulling back from the U.S. Treasuries. And they're definitely not showing up like they used to. So what happens next? Defaulting is political suicide, and that's why inflation is the silent option. This next chapter is going to be financial repression. A slow, steady squeeze where inflation chips away at everyone's wealth and the American public. So let me tell you about Hugo Stinnes, a man who became the richest person in Germany because of hyperinflation. After World War I, Germany was buried in debt. By 1921, their currency had all collapsed. But Hugo, he saw it coming. He borrowed massive amounts of paper marks, which was worthless currency, and he bought real assets. He bought mines, factories, and real estate. As inflation exploded, the debt became worthless, but the assets skyrocketed in value. What's the lesson here? He used debt like a weapon, and inflation did the rest. Does this sound familiar? Now, is the U.S. like Weimar Germany? No. But the mechanics and the fundamentals, they're eerily similar. It's not about hyperinflation. This is about financial engineering. And one of the most powerful tools that the wealthy use, whether they know it or not. Say you lock a 30-year fixed mortgage at 2%, which I know is low, but just go with me. So now inflation's running 4% year over year. That means that every dollar you repay in the future is worth less than every dollar that you borrowed. You're paying the bank back with cheaper money, and over time, that 2% gets erased by inflation. Even at 6 or 7% mortgage rates like today, if inflation is running above that, you're still winning. And that just happened just a year and a half ago. Why? Because inflation is outpacing your debt cost. Your real cost of borrowing is negative. That's the key. You don't need hyperinflation. You don't need a wheelbarrow full of paper money. All you need is time, fixed rate debt, and a system that keeps on printing. When inflation is high and you owe money on fixed terms, you're getting wealthier each and every month without doing a thing. Number one, rents rise. Inflation means higher costs, which puts the pressure right on the people who supply housing, making them pull back from the supply itself, which, of course, when there's more demand than supply, rents rise. So if you own rental property, you're going to be in a very good spot. 2, debt gets destroyed. If you locked a 30-year mortgage at 3%, which a lot of people have today, inflation is eroding your debt each and every year. 3, asset prices inflate. Real estate is a hard asset, and it is a store of value. But there is a catch. If you're over-leveraged, have a floating rate, or facing a refinance, you could get crushed, which is exactly what's happening to a lot of people right now. Real estate only wins if you're positioned correctly. You need to be in long-term fixed rate debt. You need to have positive cash flow, and I always talk about this. Do not buy for capital gains. 4, need to be in growing markets with stable demand, and that's pretty easy to figure out when you just look at the migration patterns of where people are moving. This is why I say buy on fundamentals and not on emotion, because at the end of the day, it is just math. So what do you do now? Lock in to fixed rate debt. It could be 20, 30, 40 years. It doesn't really matter. Do not wait for its perfect time and lock it in and let inflation do its thing. You can always refinance if rates go down, but you hedge if they go up. 2, focus on workforce housing. Forget luxury. Focus on where people live. Go to places with positive job growth and limited supply. 3, avoid bridge debt and short-term financing. This is not the time to gamble, and nobody really knows what's going to happen in the future. 4, build reserves. Markets are volatile, so you need to be ready, and you need to have the cash to get you through the down times. 5, buy in markets with wage growth. But because oftentimes if you're buying where wages are rising, you're going to have a better tenant, a more stable occupancy, and less bad debt. Just like their own debt, the Fed has to inflate away the debt. If the Fed has to inflate away the debt and you've got a 3% mortgage, you're printing wealth just like the Treasury. And here's what most people get wrong during a crisis. They hoard cash. Now, mind you, I totally get the fact that you do need some reserves. If the dollar is devaluing and cash is melting like an ice cube, debt, on the other hand, it gets cheaper with time. Picture this. One guy saves $100,000 in cash. The other guy borrows $1 million for real estate. Who wins? The guy who saves loses slowly because of the inflation. The guy who borrows smartly wins because the cost of the debt goes down over time because he's paying it back with cheaper dollars. So if you want to build wealth while the dollar's dying, you have to think differently. Use inflation. Don't fight it. Own assets. Borrow wisely and play for the long term. Because when currencies collapse, it's not the end. For those who are ready, this will be once in a lifetime. Gold is near all-time highs, but appreciation isn't the only way to benefit. Monetary Metals, you could potentially earn a yield on your gold, paid in physical gold, without selling it. Here's how it works. When you lease your gold through their platform, pre-qualified companies pay to use it under strict guidelines, like renting out real estate, but with gold. Instead of paying to store your metal, you may earn up to 4% annually in gold. You stay in control and you can choose which leases to participate in. Monetary Metals handles the due diligence, lease terms, and all the administration. Thousands of investors use this approach to grow their gold, not just sit on it. Visit monetary-metals.com/Ken to learn more. Leasing gold involves risk and returns are not guaranteed. This is not an offer to buy or sell securities. Please review all risk disclosures at monetary-metals.com. Visit monetary-metals.com/Ken to learn more.